Hello and welcome to this last of 4 chapters on the series of income and Social Security planning. Remember that earlier we said that the things you can control about finances in retirement are taxes, timing, and fees. We've already spent some time talking about taxes and timing. Now it's time to look at fees. There are a variety of fees and ways that they are charged or paid. Product fees are the most obscure and inconsistent. They're hard to see and they're widely varied. Now, advisory fees are paid for planning and asset management. Those results ought to indirectly pay for themselves if done properly. The biggest fees that we see are the costs of unnecessary insurance and the tax impact of buying the insurance. We sometimes find people paying income taxes on Social Security plus paying income taxes on the income necessary to pay the premiums. The after-tax cost can make the insurance plan imprudent at best. Well-meaning people will buy insurance this way or help you buy insurance this way without looking at the real cost instead of the price. If you have a situation where an annuity made sense, it came or comes in one of 3 flavors. Retail platforms usually have surrender penalties with high platform fees, often as much as 1.25% per year. The person helping you buy them often gets paid for the effort. Very well, incidentally. If you own one of these that you bought a decade or more ago, the annuity may have guarantees that are no longer available. So the fees may provide more than tax deferral, funds, and statements. Now, if your annuity's guarantees are not the reason you invested in them, you need to look at the cost. Now, you can buy advisor annuities that have no surrender penalties, platform fees are around 0.3, and funds are 0.25 or so, which is really quite nice. We can give you some options here if you have an interest in it. Now, mutual funds have their own fees. You can search for expense ratios and get a good sense of the cost. The platform or custodian you use charge custody and or transaction fees. Be aware that $5 trades are limited to certain funds. Normally those funds are more expensive. Zero fees are generally limited to a family of funds, where the fees are within the funds themselves. At Adams-Hansen Associates, most of our clients have no transaction fees, but pay a consistent custody fee. For our firm, it is the most efficient way to deliver portfolios. You can go online to Morningstar or Yahoo Finance and find a fund's net expense ratio. Now, there is very little reason to pay a front or back-end load. They can be waived or avoided altogether. The only place that paying 12b1 fees makes sense is when the fund is part of a 401k type plan and the 12b1 fees pay plan expenses. If you have money in a 401k plan, you get a statement of fees at least annually. Find out what yours are. Most plans apply fees on a pro rata basis, meaning the size of your account relative to the average account size. People closer to retirement generally have a larger account balances, so they pay higher fees. Now, sometimes it makes sense to roll a large portion of a 401k balance into a more self-directed environment once you're over 50 or so. In that case, you can have more control over those fees. We begin with the premise that you are working with a professional registered with the state or the SEC or both. Anyone can call themselves an advisor and charge an hourly engagement or planning fee. They just can't hold themselves out as being registered, so it's important that you work with someone who's credentialed. Some registered investment advisors are independent and unaffiliated. This is how we're structured. We have no affiliation with a broker-dealer. We cannot get paid commissions on investment products. Many registered investment advisors are brokers or work through a broker-dealer. They can get paid commissions and have additional financial pressures on their business that carry over to the client. Asset under management fees are ongoing and vary based on account size and complexity. Some companies charge as much as 2% per year plus 20% of profits per year, which to us seems crazy. Many people benefit for paying a project or planning fee instead of paying commissions. A credentialed registered investment advisor with experience will help you with any or all of these items. If you need insurance or help with the sale or purchase of real estate, we're paid commissions. Generally, planning fees are reduced when these things are involved because we essentially get paid for projects. We try to select a method of payment that's advantageous to our client. That's how it works in our firm. Some firms have a subscription sort of pricing model where you get a menu and select price fixed services. It seems to us like it would be hard to be comprehensive in that model, but there are certainly advisors out there making it work. We get paid to manage money, but the planning and maintenance is where our value lies. Make a note on your notes page to check the assets that you own and what they cost. It might surprise you. It can't hurt. It might help. Please look at the other presentations on our web channel. One of them is about modern portfolio theory, which deals with harvesting gains and losses. It's applicable to what we're doing here, but it's a 5-minute presentation unto itself. We have other things out there as well. So take a look. Thanks for listening.